Let's talk about the 10-year Treasury yield. It sounds complicated, but it's not. This yield is simply the return you get when you lend money to the US government for 10 years. You're basically buying a bond. This bond is called a Treasury note. Think of it like an IOU from Uncle Sam. The 10-year Treasury yield is a big deal in the financial world. Why? Because it affects a lot of other interest rates like the ones for mortgages and savings accounts. When the yield goes up, those rates usually go up too. When the yield goes down, those rates tend to follow. Right now, the 10-year Treasury yield is at 4.32%. That's higher than it's been in a while, but it's been even higher in the past. Knowing where the yield has been can give you an idea of where it might go in the future. Want to buy a house? The 10-year Treasury yield matters to you. When the yield goes up, mortgage rates usually rise. That means you'll pay more to borrow money for that dream home. On the flip side, a lower yield can mean lower mortgage rates and more affordable borrowing. Section 5. Influence on savings and investment returns. The 10-year Treasury yield also affects how much interest you earn on your savings. When the yield is up, banks might offer higher interest rates on savings accounts and certificates of deposit or CDs, but when the yield is down, those interest rates might be lower, making it harder to grow your money. Section 6. Understanding the inverted yield curve. Sometimes you hear about something called an inverted yield curve. This sounds scary, but it's just a fancy way of saying that short-term interest rates are higher than long-term rates. For example, the interest rate on a 2-year Treasury note might be higher than the rate on a 10-year Treasury note. An inverted yield curve can be a sign that the economy is slowing down. Section 7. The Federal Reserve's role in shaping yields. The Federal Reserve, or the Fed, is like the big bank of the United States. It can influence interest rates, including the 10-year Treasury yield. The Fed might raise or lower rates to control inflation or boost the economy. Section 8. Factors affecting the 10-year Treasury yield. Lots of things can affect the 10-year Treasury yield. Inflation is a big one. When prices are rising quickly, investors demand higher returns on their investments, including Treasury notes. Economic growth, government spending, and even global events can also move the yield. Section 9. Conclusion and future outlook. The 10-year Treasury yield is a key player in the financial world. It influences mortgage rates, savings rates, and even the stock market. Understanding this yield can help you make better decisions about your money. Remember though, predicting the future of interest rates is tough. It's always a good idea to talk to a financial advisor before making any big financial decisions.